Welcome back to Retirement Security Simplified. Before we dive in today, let me ask you a question. Did you know that up to 85% of your Social Security benefits could be taxable? And that's not all. Your retirement income could also trigger Medicare IRMAA surcharges that could cost you over $5,000 per year, or even more if you're married. Most pre-retirees have no idea these landmines are waiting for them. I'm Shonda Prescott, and I specialize in helping pre-retirees and retirees create tax-efficient retirement income strategies. I want to let you know that seniors can legally reduce their Social Security taxes and avoid unnecessary Medicare penalties with the right planning. In today's video, I'm going to walk you through the exact strategies you need to understand to minimize Social Security taxation, avoid those costly IRMAA surcharges, and show you how to create supplemental income in the most tax-efficient way possible. If you're within 10 years of retirement or already retired, this information could save you tens of thousands of dollars over your lifetime. Let's get started. First, let's talk about how Social Security benefits are taxed, because this is where most people get caught off guard. The IRS uses something called provisional income, also known as combined income, to determine how much of your Social Security is taxable. Here's the formula, and I know it sounds complicated, but stay with me. Provisional income or combined income equals your adjusted gross income plus tax-exempt interest plus 50% of your Social Security benefits. Once you calculate your provisional or combined income, you compare it to these thresholds. For single filers, if your provisional income is under $25,000, 0% of your Social Security is taxable. If it's between $25,000 and $34,000, up to 50% of your benefits become taxable. If it's above $34,000, up to 85% of your benefits are taxable. For married filing jointly, if your income is under $32,000, 0% is taxable. Between $32,000 and $44,000, up to 50% is taxable. And above $44,000, up to 85% is taxable. Now here's what makes this particularly painful. These thresholds were set back in 1984 and have never been adjusted for inflation. If they had been adjusted, that $44,000 threshold for married couples would be over $130,000 today. That's why so many retirees get hit with Social Security taxation. Let me give you a real example. Let's say you're a married couple receiving $40,000 per year in Social Security benefits. You also have $50,000 coming from your IRA withdrawals and maybe $5,000 in interest from bonds. Your provisional income calculation looks like this. Adjusted gross income is $50,000, your IRA withdrawals. Your tax-exempt interest is $5,000. 50% of your Social Security is $20,000. So your total provisional or combined income is $75,000. At $75,000, you're way above that $44,000 threshold, which means 85% of your $40,000 in Social Security, that's $34,000, is now taxable income. You just added $34,000 to your tax return that many people don't even realize is coming. The good news? There are strategies to minimize this, and that's exactly what we're covering today. Now, let's talk about IRMAA, which stands for Income Related Monthly Adjustment Amount. This is an additional surcharge you pay on top of your Medicare Part B and Part D premiums if your income exceeds certain thresholds. Here's what makes IRMAA particularly tricky. It's based on your modified adjusted gross income from 2 years ago. So your 2026 IRMAA is based on your 2024 tax return. This creates planning challenges, but also opportunities if you know it's coming. Let me show you the 2025 IRMAA brackets from Medicare Part B. For single filers, under $106,000 modified adjusted gross income, you have the standard premium, which is around $185 a month. If your income was $106,000 to $133,000, you pay an additional $74 per month. If it's between $133,000 to $167,000, you pay an additional $185 per month. If it's between $167,000 to $200,000, you pay an additional $295 per month. If your income is $200,000 to $500,000, you pay an additional $406 per month. If your income is above $500,000, you pay an additional $443 per month. For married filing jointly, the brackets are roughly double. Here's what I call the IRMAA trap, and this is critical. Notice how these are cliffs, not gradual increases. If you're a single filer and your modified adjusted gross income is $105,999, you pay the standard premium. But if you earn just $1 more at $106,000, you now pay an extra $74 per month, which is $888 for the year. For married couples, $1 over the threshold could cost you nearly $1,800 per year in additional Medicare premiums. And remember, this is in addition to the Social Security taxation we just talked about. So that extra income you're taking out could cost you double, once in taxes and again in IRMAA surcharges. The question becomes, how do we create retirement income while staying below these thresholds, or at least being strategic about when we cross them? One of the most powerful tools you have in deciding is when to claim Social Security. This decision impacts not just your benefit amount, but also your tax situation for potentially decades. Let's talk about the basics first. You can claim Social Security as early as age 62, but your benefit is reduced by about 30% compared to waiting until your full retirement age, which is 66 or 67 for most people watching this. If you delay until age 70, your benefit increases by 8% for every year you wait past full retirement age. But here's what most people don't consider: the tax implications. The gap year strategy. Let's say you retire at 62 but delay Social Security until 70. During those 8 years, you have what I call a low tax window. Your provisional income calculation doesn't include Social Security yet, which means you might be in a lower tax bracket. This is the perfect time to do Roth conversions at lower tax rates, take larger distributions from IRAs before RMDs kick in, and strategically manage your taxable income. For married couples, you have even more opportunities. Let's say the lower earning spouse claims at full retirement age while the higher earning spouse delays until 70. This strategy accomplishes several things. You get some Social Security income coming in. The higher earner's benefit continues growing at 8% per year. You create a larger survivor benefit. The surviving spouse gets the higher of the two benefits. You can potentially stay below IRMAA thresholds by managing when the second larger benefit begins. Here's a sophisticated strategy. Let's say you're 63, retired, and living off savings. You're in the 12% tax bracket. If you start Social Security now, 85% of it becomes taxable, potentially pushing you into the 22% bracket. Instead, you might delay Social Security and use a fixed indexed annuity to create income during these gap years. The fixed index annuity provides tax-deferred growth, and when you take distributions, it's only on the gains that are taxed as ordinary income, and you control when you take those distributions. Then at 70, you turn on Social Security at the maximum amount. Yes, 85% of it will likely be taxable, but you've delayed that taxation and maximized the benefit amount. Plus, you've potentially saved thousands in taxes during those early retirement years. The key is this: Social Security claiming is not just about maximizing the benefit amount, it's about maximizing your after-tax, after IRMAA spending power throughout retirement. Now, let's talk about one of the most tax-efficient tools for supplemental retirement income: fixed indexed annuities, or FIAs. I want to be clear up front. I specialize in these products because I've seen firsthand how they can help retirees keep more of their money. But let me explain why they work so well specifically for Social Security optimization and IRMAA management. First, fixed index annuities grow tax deferred. That means during the accumulation phase, you're not generating taxable interest like you would with CDs or bonds. Let me show you why this matters. Let's say you have $200,000 in a CD earning 4% interest. That's $8,000 per year in taxable interest that gets added to your provisional income calculation. That $8,000 not only gets taxed at your ordinary income rate, but also increases your provisional income, potentially making more of your Social Security taxable and pushing you into IRMAA territory. Now, take that same $200,000 and put it in a fixed index annuity. During the growth phase, any gains are tax deferred. They don't count as provisional income. You're not receiving a 1099 every year for interest. This keeps your taxable income lower, which helps you reduce Social Security taxation, stay below IRMAA thresholds, and potentially qualify for other income-based benefits. Strategic distribution planning. When you do take income from a fixed index annuity, you have control over the timing and amount, and this is huge for tax planning. Many of my clients use what's called a guaranteed lifetime income rider. Here's how that works for tax optimization. Let's say you need $30,000 per year in supplemental income before Social Security starts. With a CD, you need about $750,000 earning 4% to generate that income, and it's all taxable every single year. With a fixed index annuity with an income rider, you might only need $400,000 to $500,000 to generate that same $30,000 per year for life. And here's the key difference: the income from the annuity is partially a return of your principal, which isn't taxed, and partially earnings, which is taxed. This is called the exclusion ratio, and it means your taxable income is significantly lower than it would be with interest from CDs or bonds. The gap year strategy with fixed index annuities. Remember those gap years we talked about between retirement and claiming Social Security? This is where fixed index annuities really shine. Here's a scenario I use with clients. You retire at 62 with $500,000 in an IRA and $300,000 in after-tax savings. You want to delay Social Security until 70 to maximize your benefit. Instead of taking IRA withdrawals, which are 100% taxable and increase provisional income, we might position a portion of that after-tax money into a fixed index annuity with an income rider. That fixed index annuity provides $25,000 per year in supplemental income during those 8 gap years. Because it's funded with after-tax dollars and uses the exclusion ratio, maybe only $10,000 of that $25,000 is taxable each year instead of the full amount. You've just cut your taxable income by 60%, which means less tax on the income itself, potentially zero Social Security taxation since you haven't claimed yet, no IRMAA surcharges, and you preserve your IRA for later, potentially doing strategic Roth conversions in low tax years. Let me put this in perspective with a comparison. Let's say you need $30,000 per year in retirement income beyond Social Security. Option 1, corporate bonds or CDs. So the income is $30,000, which is 100% taxable. Provisional income impact is $30,000. Tax at 22% tax bracket is $6,600. Potential IRMAA impact, it could trigger surcharges, and net after tax is $23,400. Option 2, using IRA withdrawals. Your income will be $30,000, which is 100% taxable. So the provisional income impact is $30,000. Tax at the 22% bracket is $6,600. Potential IRMAA impact, it could trigger surcharges. Net after tax is $23,400. And option 3, a fixed index annuity with an exclusion ratio that's 40% taxable. Income, $30,000. Only $12,000 is taxable. So the provisional income impact is $12,000. Tax at the 22% bracket is $2,640. The IRMAA impact, less likely to trigger. And net after tax, $27,360. In this example, the fixed index annuity strategy puts almost $4,000 more in your pocket every single year. Over 20 years of retirement, that's $80,000 in tax savings. The guaranteed lifetime income advantage. One more thing I want to mention. Many fixed index annuities offer guaranteed lifetime income riders. This means you cannot outlive the income, which provides tremendous peace of mind, but from a tax perspective, it also gives you predictability. You know exactly how much taxable income you'll have each year, which makes it much easier to stay below IRMAA thresholds and manage Social Security taxation. Compare that to investment portfolios where your income might fluctuate based on market conditions and required minimum distributions. Now, I want to be clear. Fixed index annuities aren't right for everyone, and they do have limitations. They're designed for long-term income planning, not short-term liquidity. But for pre-retirees and retirees focused on tax-efficient guaranteed income, they're one of the most powerful tools available. Beyond Social Security claiming strategies and fixed index annuities, there are several other tactics you could consider as part of your comprehensive plan. You could do Roth conversions during low income years. So we touched on this earlier, but it's worth emphasizing. If you have years before Social Security starts where your income is lower, consider converting traditional IRA money to a Roth IRA. Yes, you'll pay taxes on the conversion, but you're doing it in a low tax bracket, maybe 12% instead of 22 or 24% later. Once money is in a Roth, it grows tax-free and distributions don't count towards provisional income or IRMAA calculations. This is incredibly powerful for long-term tax management. Strategic withdrawal sequencing. The order in which you take money from different accounts matters enormously. Generally, the most tax-efficient sequence is taxable accounts first. These have the lowest tax impact. Tax-deferred accounts like IRAs, managing the amounts to stay below key thresholds. And then tax-free accounts like Roth IRAs. Save these for later or for high income years. But there are exceptions to every rule based on your specific situation. Health savings accounts. If you're not yet on Medicare and have a high deductible health plan, maximize your HSA contributions. These provide a triple tax benefit: tax-deductible contributions, tax-free growth, and tax-free distributions for medical expenses. In retirement, you can use HSA funds to pay for Medicare premiums, long-term care expenses, and other medical costs without increasing your provisional income. It's one of the best tax deals available. Qualified charitable distributions. Once you turn 70 and a half, you can donate up to $105,000 per year directly from your IRA to qualified charities. This distribution counts towards your required minimum distribution, but it doesn't count as taxable income. This is huge because it doesn't increase your provisional income or affect IRMAA calculations. If you're charitably inclined and facing large RMDs, QCDs are an excellent strategy. Managing capital gains. Remember that capital gains from selling investments also count towards provisional income. If you need to reposition your portfolio, consider spreading large sales over multiple years to avoid triggering Social Security taxation or IRMAA surcharges all at once. The key takeaway here is that optimization isn't about one single strategy. It's about coordinating multiple tools to minimize your lifetime tax burden and maximize your after-tax spending power. Let's recap what we covered today, because there's a lot of information here. First, understand that Social Security can be taxed up to 85% and it's based on your provisional income, which includes your adjusted gross income, tax-exempt interest, and half your Social Security benefits. Second, IRMAA surcharges can cost you thousands of dollars per year in additional Medicare premiums if your income crosses certain thresholds. And remember, it's based on your income from 2 years ago, so planning ahead is essential. Third, when you claim Social Security matters just as much as the benefit amount. Strategic claiming combined with spousal coordination can save you tens of thousands in taxes. Fourth, fixed index annuities can provide tax-efficient supplemental income that helps you avoid triggering Social Security taxation and IRMAA penalties during those critical early retirement years. And finally, strategies like Roth conversions, withdrawal sequencing, HSAs, and qualified charitable distributions all work together to create a comprehensive tax optimization plan. Here's the bottom line. Everyone's situation is unique. Your income sources, your benefit amounts, your health status, your goals. All of these factors require personalized analysis. The strategies I've shared today are powerful, but they need to be tailored to your specific circumstances. Because you made it this far, you might be interested in the free booklet called Maximize Social Security Income. There's a link to grab your copy in the description box below. If you found this video helpful, please give it a thumbs up and subscribe to the channel. In the comments below, feel free to leave your video ideas on questions you have with retirement finances. If there are several comments on one topic, I may address that topic sooner rather than later. Thank you so much for watching, and I look forward to helping you create a tax-efficient retirement income plan. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.